everybody. I'm going to get all set up. We're a few minutes early, so I'm going to get myself set up and my screen shared and all of that good stuff. And let everybody get jumped in so we can get started online on time. I see a lot of familiar names. Hi, everybody. I think I'm set. I just stayed a kind bar because these hit right at lunch. And I do that on purpose because I want it to be your lunch hour. Maybe you've got more time. But I get hungry and I eat on a regular basis. So I just ate a bar. I've got a fan over here in case I get hot. I've got the AC turned down and I replenish my water. So I think we should be good to go. Just a couple more minutes. We still have a lot of people jumping on. We had about 200 people register. So that's cool. This is a hot topic, this employee retention credit, which is where we will spend most of our time. And then at the end, we can talk about the HHS Provider Relief Fund. There really are not any drastic updates, so I can break that news now. There's not a lot of updates on that front at all. I really would not be surprised if reporting for 2020 ends up getting pushed to July like the reporting for 2021 is scheduled for. The problem with that, and they might even push that date, is that all 12/31 year-end Medicare cost reports, and maybe even some other year-end dates like October, November, maybe, I'm not sure, don't quote me, but I know the December year-end dates, they're all due July 31st. So to put HHS Provider Relief Fund reporting on top of cost reporting for the same due date, oh, that'd be a lot. It wouldn't be unexpected, but I hope that's not the case. That'll really challenge us hard. So anyways, all right, well, let's get rolling. Like I said, I see a lot of familiar names. I won't call everybody out. Sometimes I think I embarrass them. Although, is Eddie here? Because I told Eddie I would call him out and embarrass him because he said he always listens to my webinars while he's working out at the gym. So, but I don't see him online, so he must not be here this time. Anyways, let's get rolling. A little housekeeping thing. First of all, if you've got questions, please put it in the Q&A chat panel. The actual, not the chat, but the Q&A. It allows me to really keep those organized. And like I can tell if I've answered them or not. So that keeps everything organized. Go ahead and ask questions as they come up. I'll glance at it. I'll keep an eye on it. I might wait until a certain spot to answer questions, but I will answer questions and I'll stay on as long as you guys need to answer any and all open questions that you've got. You know, we are still very well versed in the, what's it called? PPP loan stuff. We're not discussing that here, but I can answer questions if need be. So let's get started. So of course, my name is Amy Knight with Knight CPA Group. We are here in Austin, Texas. I'm actually from Oklahoma. Funny little side note, I went to OU, and I do have an OU grad on staff, Shayla. She's an OU graduate, but I threw a Hail Mary, not ad, but I posted a post on Facebook in my neighborhood down here in Southwest Austin, saying I'm desperately looking for an admin. It could be an intern position, yada, yada. So I got 2 responses from accounting students, and they're both OU accounting students that live here. I love it. I was all excited. So anyways, I would hire all Sooners if I could. We do have Paul, the diehard Longhorn, on staff, but you know, we'll let him slide. Anyways, we are a CPA firm. We only work with home health, hospice, nursing homes, assisted living, maybe some little minor offshoots of that. I've got one that's an outpatient rehab, drug and alcohol rehab clinic. So I have a few little other things. We got a DME, but I'm not as well versed in those. That being said, I do want to say we are going to spend bulk of the time talking about this employee retention credit, which is not exclusive to our healthcare niche. If you're listening and you're not in home care or healthcare in any way, I'm not going to go into every facet of this regulation and this credit. I'm going to focus, and I'm going to talk directly to my niche of home health, hospice, nursing homes, assisted living, because there are lots of rules and lots of it. And I'm just narrowing it down to what applies to us and our niche. So I just want to put that, not warning, but that caveat out there for anybody that might not be in our little world. So know that there is more. This is not the end all be all, but it is what is relevant to our group of attendees. And I think that's why people come to hear me. So let's get started. So ERC is the buzzword, and I was giggling because we got really working on it the very 1st of April, which happened to be Easter weekend. And so ERC, if you say it fast, sound like Easter. So for me, it was ERC weekend and not Easter weekend. And anyways, I got a lot of work done. To date, we've calculated about $2.5 million of credits. We haven't done it for that many people. I should have looked at my count, but let's say that is 8. So, I mean, these are can be substantial credits. So it's definitely something that you don't want to ignore. So right here, my first slide jumps into what changed. And the reason why we address it that way is because this is not a new credit. It just got significantly changed in the December Appropriations Act, or whatever it was called. I'm sorry, I can't keep up with all of them anymore. The one that Trump signed on December 27th is what this came from. So in the beginning, the reason why we didn't pay much attention to this credit is because if you received a PPP loan, you were excluded. You didn't qualify. If you didn't receive PPP loan, you did qualify for it, but everybody we worked with got a PPP loan. So we threw it on the back burner and said, okay, this doesn't really apply for us. And so we just kind of ignored it. Well, then when they came out in December, they made drastic changes, and they basically took away that exclusion of PPP borrowers could not take advantage of this credit. And not only did they do that, but they also loosened a couple of things. They loosened the restrictions, and I'm sorry, my nose is just tickly. And they also made the credit even more advantageous, a bigger credit, okay? So I'm trying very carefully to use proper words that don't make it sound like we're trying to take advantage of something that wasn't meant for us. And so it's not a matter of taking advantage of anything in any wrong way. It's taking advantage of what's there for you to use. So employee retention credit, the design was for, I don't want to say providers, but companies to keep their employees paid, even if they were not able to operate. Keep your employees paid, the government will give you a credit and basically help subsidize those wages. That was the intent. And so in their original, and this still stands, so these, the 2020 rules still apply for the quarters of 2020, except that PPP restriction that has been completely removed. So now for 2020, you have to show a 50% reduction in revenue in order to qualify. And that reduction in revenue is from one quarter 2020 versus the same quarter 2019. You got to compare quarterly revenue totals, quarter to quarter, okay? But for 2020 to qualify, you have to have a 50% reduction in that quarter, okay? And it gets more complicated than that, but I just want to go through these differences. Now, fast forward to 2021, you only have to show a 20% reduction. Again, this is why we're getting on it now, because for 2021, that criteria has come down quite a bit. It opened it up. A lot more providers will now be eligible. Very few providers that I've worked with had a 50% reduction in gross revenue in 2020. Fortunately, right? You were all essential business. You carried on business. A lot of people took a hit. Don't get me wrong, but not very many took a 50% hit in revenue for an entire quarter. Okay. So it's for 2021, it only has to be a 20% reduction in revenue. Again, now on both years, PPP borrowers can participate. 2 seconds. Okay, sorry. Home is texting, and I should have told him what time my webinar was. He thinks I just sat at my desk all day. Small employers, it's still considered small employers. And you know what? I wish I could edit in this format right here, because I did some digging on this employee count and did some detailed research. So in 2020, it was 100 employees or less. 2021 is now 500 employees or less. However, there's a catch. It came out in the FAQs, the frequently asked questions, which is where they do a lot of the clarification. Like they initially put out, here's the guidance, and then everybody has questions. Then they come out with an FAQ to answer very specific questions. The question is, how do you calculate this 500 employees? It is 500 full-time employees. It is not a full-time equivalent calculation, okay? Key to note that, because I know a lot of you provider services have tons of part-time employees, and it is full-time employees. And so each full-time employee counts as one. So anybody that works 30 hours or more a week on average is considered full-time, okay? Also, you do have to aggregate. So this means if you own multiple companies, you have to add them all together and meet the 500 employee criteria. And in 2020, it was 100 full-time employees, okay? So again, that alone excluded a lot of borrowers. Even if they moved the PPP exclusion, you still don't qualify under 100 employees and 50% reduction, right? So again, 2020, far more difficult to qualify for. 2021 opens it up substantially. So now let's say you've had a 20% reduction in revenue and you're under 500 employees. What does that mean for you? Then that means that for wages paid in 2020, they were giving you 50% of wages paid per employee back in a credit, up to $10,000 in wages per employee. Okay, so that sounds confusing. Let me be more clear. For every $10,000 of wages paid per employee, you could claim a credit of 50%. So your max credit per employee was $5,000. And that was per year. Okay, that was an annual limit. So then moving on to 2021, they've upped it. It's still a $10,000 wage base, so $10,000 per employee, but the credit goes up to 70% of wages paid up to $10,000 in wages. Therefore, that's a max of $7,000 per employee for the credit, but that's per quarter. So let me put that in some perspective. $10,000 a quarter is a $40,000 person, employee. So on a $40,000 employee, you can get $7,000 per quarter that you qualify. You have to qualify each quarter. It doesn't just roll for the whole year. This act did extend it for the year. It extended it through June, and then they've come back even since then and extended it all the way through December. So we have all 4 quarters of 2021 to work on this or to review this and watch and see if you're eligible. You may not be eligible one quarter, but maybe you are the next. So that's what you want to be evaluating. So that limit is per employee, and in 2020, it was per year. In 2021, it's per quarter. In 2020, you cannot raise salaries to maximize the credit. In 2021, you can. So if you know you qualify and you want to pay somebody more than what they usually get paid because you're going to get credit for it, that's allowed. That one honestly, frankly, shocks me, but it is allowed. I will say that the salaries had to be paid. These could not be accrued salaries. It can't be accrued bonuses. You have to have paid them. You can get a request. You can request in advance on the credit. That's done via Form 7200, but you can only do that if you have not filed your 941 yet. So we're working those right now for first quarter 2021 by filing that request for advance before we file the 941. The credit actually goes on the 941. The request for advance is something you can file. You can actually file it ahead of time. Like if you know you qualify for second quarter, and I'll get into that in a minute, you could file the form and say, hey, we qualify, we want an advance credit. We think we're going to qualify for a $100,000 credit. We want it now. Well, I will say they're reporting it takes 6 to 8 weeks to process and refund based on that 7,200. There's not even guidance on how long it's going to take them to process amended 941s. And so that's still weeks out. And that's what they're claiming. We don't know yet because we haven't seen it yet. So still to be determined. We don't know what the realized length of time is for them to process those credits. So this last point here is super complicated and took me weeks to get my mind wrapped around it. Your eligibility continues until the quarter in which you get back to 80% of that same quarter in 19 revenue. And the first quarter that you hit 80% or more of the 2019 revenues, you still are eligible in that quarter, then you're no longer eligible. Tricky. I've got some examples to walk through. And then in 2021, now you can do a look back. So you can use the previous quarter to qualify you for the current quarter. So a lot of the work that we did, we were able to jump into it that last week of March because we knew they qualified based on quarter 4 of 2020 using the 21 rules. So fourth quarter 2020 was down 20% or more versus fourth quarter 19. So that qualifies them for first quarter 2021 by using that look back. So we jumped on those credits and we said, okay, we know they qualify for first quarter. Let's get that calculated. So those are the changes. That's very key to kind of have a nice little side-by-side comparison. But let's go into, I really want to spend the bulk of the time on the eligibility of it and not get into the minutia of calculating the credit. Although it's, that part's straightforward. And so anyways, let's go through these examples. So 2020, this is for 2020, how to determine your eligibility, because one thing I should make clear, no, you cannot use third quarter. You can't use quarter 3 versus quarter 1. Like you can't, it's got to be quarter to quarter. If you were not in business in 19, then there are special rules that you can use different periods, but only if you were not in business in 2019. So let me go through these examples and then I'll answer questions. So for 2020, and I'm sorry, I started to clarify. The reason why we're still talking about 2020 is you can still claim that credit for last year. It does 2020 first quarter, irrelevant. You might have a credit to claim, but it's only from March 27th, like it's 3 days. And then it gets put on second quarter 941. We do know that, but it's only for a few days. Honestly, in my opinion, that's a lot of work to calculate 3 days and figure that out. And honestly, also in our industry, most of us didn't really start feeling the pressure of the decline in revenue until at least second quarter, and a lot more were. Unfortunately, it was a crossover between second quarter and third quarter. Really, we saw the impact around Texas in May, June, July is what I saw. So anyways, so again, we're talking about 2020 because you can go back and calculate and see if you qualified. A real easy determination, if you did not qualify for round 2 PPP loan and you looked at that, then you automatically do not qualify for ERC in 2020, because for PPP loan 2, it only took a 25% reduction in revenue, and this requires a 50% reduction. So if you didn't qualify for PPP 2, then you didn't qualify for ERC. So what we did was we took all of our PPP 2 and we said, okay, they qualify. There's a good chance they might qualify because they at least met the 25% reduction. So let's see if they actually hit a 50% reduction. And it's the exact same comparison. I used the same spreadsheet to compare revenue. I did a spreadsheet. It had 2020 revenue, 2019, and that had the quarters. And I just calculated the difference, looked at the percent, and that's how I know. Okay, so in this example, so this, we're comparing 2019 receipts to 2020 receipts, and we've got a percent, and this means 2020 revenue as a percent of 2019. So this is not the percent of decline, it's what percent of revenue do we have versus 2019. So this company's normal gross receipts is 300,000. First quarter, they had 300,000. They're 100% whole. They're good to go. They do not qualify. However, second quarter, they take a huge hit. They only have 100,000 in gross revenue. So they only have 33% of the revenue as compared to that quarter in 2019. So that means they took a 67% hit on revenue. They have a 67% decline. So they qualify for that quarter. All right, roll into 23rd quarter. Now they got their revenue starts ticking back up, but they're still only at 47% of the prior year's revenue. So they still qualify. They still haven't hit 50%. But remember, I said there's that rule that you continue to qualify until you hit 80% or more. And that's why in this example, we're showing it as a percent of the prior year's revenue instead of a percent of decline. So in fourth quarter, they're almost back to whole. Okay, now they're at 83% of the prior year's revenue. And yes, they're over the 80% mark, but they still qualify because that's the first quarter they hit that 80% threshold. So that in this example would be the last quarter they would be eligible. Okay, moving on. Another similar example, first quarter they're whole, no qualification. Next quarter that same, they're only 33% of revenue, so they qualify. Well, now they really rebound quicker. So in third quarter, they rebound back to 83%, but they still qualify because that's the first quarter they went to 80% or better. And then the next quarter, they actually dipped and they're below 80%, but they're not back down to 50% or less. So they do not qualify. So this is where it's very complicated. Moving on to 2021, different set of rules now. 2021, same kind of scenario here, and I didn't take it on out further. Well, at the time, it only went through second quarter. So again, first quarter, they're down. They have 75% of the revenue they had in 2019. So bear in mind here, you're not comparing 2021 does not compare to 2020. It compares to 2019. Unless you were not in business in 2019, those rules get very detailed and I'm not going to go over them here, but you can look them up. It's easy to Google and find the FAQs for this employee retention credit. Okay, so they're at 75% of 2019 revenues. That means they took more than 20% decline. They have a 25% decline. So they qualify for first quarter based on first quarter. Therefore, they automatically qualify for the next quarter because in second quarter, they're whole, but we get to look back to the prior quarter. Okay, so that's the trick there. You're whole for second quarter, but the fact that you qualified in first quarter based on first quarter results flows over to second quarter. Let's take, this is a very real scenario that I'm looking at across my client base. So we've got this scenario where, again, this is for 2021 eligibility, but we're going to look back to fourth quarter of 2020. And in fourth quarter 2020, they didn't qualify under the 2020 rules because they didn't have a 50% reduction. They only have a 25% reduction here. But it's because it's a look back period for 2021, we only need a 20% reduction and therefore they qualify. So they qualify for first quarter based on fourth quarter results. So when that happens, that qualifies you for the next quarter, which is first quarter, but it doesn't automatically qualify you for second quarter because in second quarter, you look back to Q1 and Q1 in this example does not qualify because they actually had 82% revenue, which means they only had an 18% decrease, okay? And you just keep doing that quarter after quarter. So now what about qualified wages? So now if you qualify, how do you calculate your credit and your qualified wages? So this is qualified wages. So you've got three different employees. You've got employee A, B, and C. Employee A is paid $15,000 per quarter. Employee B is paid $7,000 per quarter, and employee C is paid $3,000 per quarter. Well, this is a 2020 example. And so for second quarter, this are their qualified wages, second quarter 2020. You only get to count up to 10,000. Well, this person didn't get paid 10,000, so you get to count all of their wages. Same with C. But because that limit is an annual limit, you have to review it quarter by quarter, and you got to accumulate it quarter by quarter. And you've got to be very careful with this. You can't count this guy's 10,000 wages every quarter. He or she gets none for third quarter and no eligible for fourth quarter because they were already maxed out in second quarter. Then your $7,000 employee, well, they get paid another $7,000 in Q3, but only $3,000 of it qualifies because that's going to max them out at the 10,000 max. And then nothing for the next quarter will qualify. And then your $3,000 attendant will qualify, all of their wages qualify each quarter because they never maxed out in this example. So you add up your qualified wages and then you just apply the credit ratio, 50%. So that's what your credit would be just in this very, very simple example. Now, going on to 2021 qualified wages. Similar setup. Again, I didn't pull it out through the whole year. But same employees. However, that 10,000 counts each quarter. Same thing with the 7,000 each quarter. They don't max out unless they're paid over the max each quarter. So you get to count their wages. It doesn't max out for the year. Okay. And again, same thing. You got to, you add up your eligible wages and you calculate your credit. And I know calculating the credit, it sounds super simple. Well, it is compared to figuring eligibility, but it's not this simple. There's a lot of the Form 941 gets completely changed. There are 3 lines that ask for specific numbers, but then all the math changes. If you work with a payroll process provider, then you got to work with them to get the numbers entered properly. They may or may not do that. A lot of them are just requiring you to file amended 941s. So there's all of that to work through. It does get kind of ugly. So let me jump back before we go into that next little topic, and let me answer some of these questions. Tyler, so no, you cannot use Q3 2020 versus Q1 2021. Again, it's got to be the same quarters. Just to clarify, if we're a home health agency with 1,000 employees and only 250 are full-time employees, 30 hours or more, then we qualify for the ERC on 2020 based on small employer, 500 employees. Yes, as long as you have aggregated all of your businesses. And that has been clearly defined in an FAQ. And to be very fair, I only just found that last week. I believe it came out. So, hi, John Skapansky. Question, do you compare a quarter in the previous year if you receive an increase in reimbursement for the following year? So reimbursement rates were more in 2020. You're correct, it can be deceptive, but it is what it is. You have to compare gross receipts. I do get asked the question a lot, is it cash basis or accrual basis? And my answer is you need to go with however you normally present your financials, however you normally do your bookkeeping. Don't try to get tricky and say, oh, well, if I do it on a cash basis, say you always keep everything accrual basis, but then on a cash basis, billing got behind. And so you want to flip it to a cash basis for this purpose. I mean, there's nothing that says that you can't do that. I would just be careful with it. I'm starting to get a little blatant of manipulation, and I like to stay away from manipulation. I have a couple questions in chat. This is a national, so it's not a tax credit. That's a really good question. We're calling it a tax credit, but it's actually, there's 2 parts. There is a non-refundable portion. That is a true tax credit, but it's a tax credit against your payroll taxes. Every business pays payroll taxes if you have employees. If you don't have employees, you don't qualify for this period. So it is a payroll tax credit, but that portion is non-refundable. It's your Social Security, employer Social Security tax, you get a credit of that. But then the rest of it, this wages, is a refundable credit, which means that even if it's more than the taxes you paid in, they will pay it to you. So you're correct. Referring to it as a tax credit, which is what we're all calling it, is a little misleading. It's actually subsidizing your wages because it is a refundable credit, which is very similar to, think about, and it is national, think about it in the sense of earned income credit, if you guys are aware of that one, where on your, well, I don't want to say that wrong, but earned income credit is a refundable tax credit. And basically that means that, if you get the earned income credit on your personal income tax return, let's say you pay $1,000 in taxes and your earned income credit is $4,000, you get back the $1,000 you paid in plus the $3,000 that you didn't pay in. That's called a refundable credit. And this isn't one of those. It is a refundable credit. The wage portion is. Is the calculation based on total wages paid or employed to the employee or only the employer's portion of FICA? It's total. It's two different calculations. There are employer Social Security tax is one part. It's not refundable. Employee wages is refundable. And then possibly health insurance paid by the employer is in there somewhere. I don't have much of that, so I don't know the detailed rules on that. But it is not the full FICA portion, so be careful with that. Are the 21 changes applied retroactively to 2020? No. Well, I mean, it depends on which change you're talking about. Some of them, yes. The PPP exclusion, that's removed for 2020, but the 70%, the 10,000 per quarter, that does not go back to 2020, nor does the 20% reduction in revenue. That's all 2021 only. How do you compare the quarter in a previous year? If you, okay, that's the same question I already answered. Is the refund taxable? It is. No, ADP does not automatically do this. I do know that for certain. Nobody is automatically doing it. I would also caution you. I have a client that said, oh, Gusto is doing this for me. They said I qualify. I know for a fact they don't qualify. I know for a fact that you as a healthcare provider are essential business, and therefore you were never shut down by a government order. And that's what Gusto told my client that they qualified under, because I know my client didn't qualify under reduction in gross revenue. And I know they don't qualify under a government order. That is super clear. It says you have to be able to produce a government order that shut you down, not your patrons, not your patients, not that your patients were scared and wouldn't let you in their home, not that there was a government order to lock nursing homes and therefore you could not access your patients. That did not shut you down. It's very, very clear. So I caution you about trusting the payroll company. They are not well versed in this. I know I've done multiple credits for ADP payroll clients. So ADP is not doing it for you. The tax refund is taxable in a roundabout way. It's not that the credit is taxable. You cannot deduct the wages that you get the credit for are not deductible, which is the same thing as saying the tax credit is taxable. Just, I don't want any CPA on here trying to call me out that I said it wrong. So I'm going to break it down into layman's terms. Yes, it's fully taxable. So you do need to be aware of that. You will get hammered on taxes with this. So be smart about it and, you know, try to save, I guess, if you would. Again, I want to make sure I was clear. I tend to jump around. I'm really sorry. If your reimbursement rate increased in 2020 and you did more volume and you were paid more in 2020 based purely on a rate increase, you still got paid more. So there's no way around that. Our 941s are filed through QuickBooks. Will you be able to make the needed adjustments if QuickBooks has it listed properly? So what I'm recommending is that if you file through QuickBooks, don't file yet. If you're talking about first quarter, don't file yet. And you're probably going to have to file on paper. The last one that I just did, she tried to change her numbers in QuickBooks and it wouldn't accept it. So we had to do one on paper and she's going to have to sign it and mail it in. I still think that's better than letting QuickBooks file it and then you file an amendment. I would stay away from amending if at all possible. You don't have a choice with 2020. You're going to have to amend those. There was a rumor circulating that the IRS said that they would not even touch 941 amendments and they wouldn't even look at them until July. I cannot express to you how backed up the IRS is. when we started 2020 filing season for income taxes, they hadn't even processed all the 2019 tax returns. They are understaffed. They've been shut down. They've had to go remote. They're not capable of being remote. They don't have the systems in place. It is not only that, but then all of 19 filing season was delayed. The impact this has had on the accounting industry, I think, has been greatly overlooked. It's amazing. It's amazing. My goal is to not die at my desk. Put it that way. My health is suffering a lot, but I get up every day, keep going at it. So to be clear, can we compare Q1 2021 with Q1 2019? Yes. But if that does not have a 20% reduction, it's got to be a 20%, not 25. Then you can compare Q1 21 to Q4 20. No. So when you do the look back, so your first quarter on its own does not qualify versus first quarter 19. So then you look back to Q4 and you got to say, does Q4 20 versus Q4 19 give you a 20% reduction? It's not Q1 21 versus Q4 20. So it's not just from one quarter to the next. What they're trying to do is account for seasonality. So like if you look at my business, Q2 is big for me, right? So when I do all my cost reports, tax returns, so I can't manipulate it. And then the Q4 always sucks. Like, we just don't have, although we're always busy, but whatever, so Q4, if I compare that to my busy Q quarter, I mean, I can skew those results. So you have to compare the same quarter in one year versus the same quarter in another year. So again, doing the look back, Q4 20 versus Q4 19, okay? And also what you're also getting at is 2019 is basically your baseline. So you're always going to compare back to that one. So even if we get to fourth quarter 2021, you're still going to be comparing fourth quarter 21 to fourth quarter 19, because I want you to compare back to your baseline before COVID, not compare back to your COVID year, which is good, because if you dipped for COVID in 20 and you take 21 versus 20, you're less likely to have a reduction. But if 19 was normal and high, you'll have a much better chance of qualifying. So kind of think about it. You can't always think about anything logically with regards to IRS, but that one actually is fairly logical. Okay, I think I answered all those. And then my next slide actually is about the taxability of it. So again, the proper way to say it is that you're not allowed to deduct the wages that were reimbursed by this credit. But the simple way of saying it is that the tax credit is taxable, which is honestly how we are showing it. When I say that's how we're showing it, we have created, we use QuickBooks as separate. In QuickBooks, you've got revenue, you got regular income, and then you've got other income. We're putting all of this down in other income. We have other income, HHS Provider Relief Fund lost revenue, HHS Provider Relief Fund additional expense offset. We have not HHS, but other income, CARES Act payroll tax credits. So for the emergency paid sick leave, the expanded family medical leave act, those credits, we record them separately. PPP loan forgiveness is recorded separately. And then this employee retention credit, all of those are all going to have separate line items. I don't want them balled together because every one of them has a different impact on tax return and on cost report. So Carlos is asking, so we reduce the amount of wages paid line on the tax returns. Technically, yes. Technically, yes. Helen, hi. We did do the quarterly comparisons, but only for our monthly clients that we do monthly work for. So if anybody, and I will get to that, we are engaging to do this work for people. What we're doing is basically we will charge a 15% fee for 15% of the credit. And the way it's going to work is, if you're interested, email me. I've sent emails out, so we've gotten a lot of response. But if you're interested, email me. We'll send an engagement letter. And the email explains this rule, because I want you to be able to kind of weed it out yourself. If you know that, hey, I've got to be able to show a 20% decline in revenue, and I know we don't do that, then don't bother. But if you think you do and you need me to review it, the way we're doing it is we're going to charge $500 to start. We'll charge that when you sign the engagement letter, and we will review your eligibility. So we're going to charge $500 to verify that you're eligible. Once we determine you're eligible, then we charge a $2,000 retainer to do the work. We'll do the work. We'll get it all calculated for you, whatever forms it takes. That's going to include any and all scenarios, whether we have to do a fresh 941, an amended 941. We are doing power of attorney, so we can talk to the IRS on your behalf. That's going to cover everything. And both of those, the 500, the 2,000, will apply. They're going to act as retainers, and they will apply towards the 15% fee. Then we take the rest of the 15% when you receive your refund. So we're waiting until you get the refund. If for whatever reason the IRS runs out of money and Biden quits printing it, and you don't get a refund, then we will not collect any fee or hold you responsible. So if you don't get paid, we don't get paid. That's why we're working on a contingency basis. So Helen, if that answers your question, just let me know and we can review that for you. Back on this reducing the wages on line item on the tax return, I'll be very honest. I'm not exactly sure how we're going to do that. And I am guessing, first of all, qualification. I don't do taxes here in the office. My husband asked the other day, hey, how do our taxes look? I said, dude, I don't know. Well, I don't do those. And, but I would not be surprised. And there might already be a line. I know that I'm pretty sure there's a line for wage credits on the tax return. And so I think that's where it's going to go. So I think you're still going to report total wages paid, because we always tie that out to total wages paid. And so does the IRS. They want to see that that matches your 940. Doesn't match your W-2s, but it should match your 940 gross wages, give or take. That gets complicated. But I think there's a separate line item for credits. And I'm guessing that's where we're going to report that. I don't know that answer yet. So I wanted to be clear on that answer. What if my LHCSA opened in third quarter 19 and I have no data to compare to? Okay, Adriana, there are special rules about that. I don't have them. It does say to compare to, it'll tell you very specifically what quarters to compare to what, because you won't have first quarter, second quarter of 19. And so it even goes into, if you started in the middle of a quarter, how to handle that. So, look, if you'll Google that, I would Google employee retention credit, not in business 2019. It's in the FAQs somewhere, and I'm sorry, I don't know that one offhand. What happens if the refunds extend past 2021 filing and you do not deduct the payroll tax expense? That's another very good question. We are not, and actually they, how did they say this one? Hold on. I believe, don't get me lying, but I'm pretty sure the IRS came out, I'm trying to remember if they said that you don't deduct, you don't basically include it as taxable until you receive the credit, the refund. 99% sure on that. I'm going to make a note because I should know that. And what I'll do is I'll look that up, and in the response, the follow-up email that everybody will get tomorrow with a recording link and the slides, I'll put that in the email. So watch for that. So hang tight just a second. Tax in hopefully it doesn't take them till 2022 to issue those refunds, but I understand why that could be a possibility. Okay, so I think I'm caught up on questions. Next, this one, look at this one, you guys. So far, a lot of things we've had to exclude owners, and this is the one that you don't exclude owners, but you do have to exclude related party. Now, let me be very transparent. There is still a lot of debate about this. You've got some really hardcore CPAs on both sides of the aisle arguing vehemently against each other. Some are saying that the way it's worded, owners are not excluded. And when I say this, I'm talking about one or two specific words in the regulation. And then others are saying it clearly says related to an owner. It doesn't say the owner is excluded, anybody related to the owner. And so our stance is owners are not excluded. So you might hear opposite out there. It depends on who you listen to. My stance is owners are not excluded, but children, siblings, parents, aunts, uncles, any related party, those are excluded. So a lot of you PAS providers, a lot of you home care providers have relatives working for you, and we have to exclude those. So, you got to be sure that we know who they are so we can exclude them. And there's also no limits on owners or the owner spouses. Employee in question, does it have to be full-time employees or part-time employees? Okay, so again, that's full-time employee. Okay, wait a minute, let me be clear. Maybe this question is different. I find it fascinating how everybody interprets things differently. I think that causes a lot of communication problems. And so I just found a pitfall I might have fallen into. The employee count only qualifies you, right? They're trying to exclude big, large employers. So that 500 for 2021, 100 for 2020, that employee count is full-time employees only. Like actual full-time employees. How many full-time employees do you have on staff at any given time? However, the credit applies to all employees. They can be part-time, full-time. It does not apply to contractors. It does have to be W-2 wages, but for all of your attendants, so the one that said they have 1,000 employees and only 250 full-time, there's 750 attendants that all work part-time. All of those wages qualify. And if you think about it, not very many attendants make $10,000 a quarter. That means of your attendant wages, 70% of what you pay is going to be refunded back to you if you qualify. That's why I say these can be so large credits. What about constructive ownership, and how does that affect 50% rule? That is going to get over, I don't want to say over my pay grade, but over my knowledge at this moment. There are lots of rules about change of ownership, but I would need more detail about constructive ownership. If it's common ownership, then it's common ownership. That one is called an affiliate rule. So those are called affiliate rules. And so that's what you would Google there. Employee retention credit affiliate rules. And it gets very detailed. So hopefully that can answer the question. With an LLC, where the owner only gets paid via profits, how would that be calculated into? It would not, and you're clearly not one of my clients, because I have a very firm stance on this, and I will argue it in front of the IRS tax court any day. We pay all of our LLC owners are paid on wages. And that is because I need your wages in my cost report, and that trumps the IRS regulation, in my opinion. So I've got CMS cost reports and I've got HHS cost reports. Both of them need to know how much it costs to run a business. And unless you don't run the business, then I need your salary in the business as a salary. That's my soapbox on W-2 on LLCs. Louise, you're right, and whoever's guiding you, they're reading the IRS rules as they are, but I've been doing this for 20 years and I've never been challenged on an LLC owner being paid W-2 wages to make sure that I'm including reasonable compensation in my cost report. And it doesn't affect your tax situation at all because you're going to pay payroll tax on $100,000 wages. Well, as an LLC owner, you're going to pay self-employment tax on a K-1 that you paid yourself if you pay yourself that way. So I stand, and I may be the only one of my kind, and that's fine. I like that. I do not tell my LLC owners that they cannot pay themselves wages and only take distributions and be paid, or even guaranteed payments. I mean, that's another way to do it. But again, 20 years, never been challenged. And at the end of the day, the IRS is getting their money. There is no tax implication change on an LLC owner being W-2 wages or K-1 net profits. Doesn't change taxation whatsoever. So, okay, sorry, that was my soapbox on that. So you could have 2,000 part-time employees and qualify. According to that FAQ, yes. If you'd asked me this 2 weeks ago, I would have said, probably not, because you need to calculate a full-time equivalent, and you probably wouldn't pass. But it clearly said full-time employees, not full-time equivalent. It literally says that. So I'm just relaying what it says. Again, frankly, I'm quite shocked at that. But you know, another thing that you have to go on, now granted, this is not an SBA program, but remember that the SBA has what they call alternative size standards. And I was asked about this yesterday. That basically goes by industry. And it says, okay, if you're in a certain industry, you might have a lot of employees, but you might qualify under gross revenues test, which is $15 million in gross revenues, still qualifies you as a small business according to SBA, and they disregard your employee count. So there's that. How does this work? Does it come as a credit or is it forgivable? So this is a credit. You will be refunded. You'll get a refund. It's not forgivable, comes from a loan, and a loan is therefore forgiven. This is a credit. And then the third thing would be there are grants. So like your HHS Provider Relief Fund, that's technically a grant. HHS DAD's rate analysis has determined that PPP loan forgiveness is a grant. I don't really see it that way. We're trying to fight that with them. We being TAC and myself and some others. Although I don't want them knowing that I don't want dads knowing that I'm involved. You know, I don't want them scrutinizing my cost reports any more than they already do. Okay, so let's see what's next. Now, this is very, very important, and we're coming up on an hour. I've got 2 hours marked off on my books. We usually run about 90 minutes, but this is very, very important. So what happens if you got a PPP loan and you're getting forgiveness? You cannot use the same wages for both. You cannot say, okay, I paid Joe $10,000 in first quarter. I got a $7,000 credit for him. Oh, and I'm going to put his $10,000 of wages on my PPP loan to forgiveness. You cannot double dip. This is where it gets a lot more complicated. If you have a PPP loan during a quarter that you qualify for this credit, you've got to strategize that. So a couple of things. So the first point says you can't double dip. I think I made that clear. The second point is a lot of people started getting these PPP2 loans in first quarter. So we're strategizing. Well, if you qualify for the ERC credit in first quarter, my recommendation to you is you postpone spending your PPP loan until second quarter. We don't know yet if you're going to qualify for second quarter ERC. And you can't just keep postponing PPP, but you can easily postpone from first quarter to second quarter because nobody got a loan. The earliest loan I saw that was received was February 8th. And so I counted the weeks. Remember, PPP, you have 24 weeks. So they could easily push it to April and then still meet their 24-week spending period. Then you can take full advantage of first quarter wages on ERC. Now, what you could do is any wages paid over the $10,000 to an employee, that could then be applied to PPP. But then we can push it off. Now, if you also qualify for quarter two, you're going to have to do your PPP spending. Then anything left can go to ERC, right? So, or vice versa. Like, you've got to strategize that. This is a side note. There is a risk, because the way we had this phrased earlier was, should you wait to even apply for PPP? Because you could wait until April and then definitely not get it until April, and then first quarter's clean and can be ERC. But then people were asking, well, is PPP money going to run out? And honestly, back in February, we were saying no. But it's been extended to May 31st. Nobody expects it to last to May 31st. They do expect it to run out. I did hear April 15th, which is tomorrow, that it might run out by then. I don't have any updated numbers on that. I do know, complete side note, round two was a complete disaster and very difficult. And we saw loans taking 8 to 12 weeks to get funded. We still have one not funded. It was so bad, we started turning people back to their bank and saying, you need to just work with your bank directly, and we can't help because it's a disaster. Is there a risk of the IRS changing the rules again? This has been super interesting. The IRS has came out very favorably, especially on the second bullet point. What we were afraid of was that the IRS would say, no, you have to apply PPP dollars first before you can apply ERC credits. And that would have been the very aggressive stance for IRS to take. And they came out and said, no, we don't care. You just can't count them both. That's kind of what came out. Probably not that direct, but that was the interpretation. Everybody sighed a big sigh of relief. So IRS has been pretty favorable about this. Maybe it's because they took such a hard stance on the PPP taxability early on and they got overruled. And maybe they're like, you know what, we're not going to waste our time on this one, then get overruled again. Let's just go with the flow and just be easy about it. Can you get this ERC credit even if you don't have the PPP loan? Yes. So if you don't have a PPP loan, that doesn't affect this at all. Well, it does. If you have it, you can't spend the same dollars on both programs. You can't count them in both places. But if you did not get a loan, that does not affect your eligibility at all. All right, that is all of my questions. So let's jump into HHS provider relief funds. Again, the big update is there is no update. Reporting, and I'm sorry about my little itchy nose, it just tickles. Reporting for 2020 is still indefinitely postponed. We have not heard a peep about reporting since they made that announcement back in the end of January. I should state this, the portal is open for registration. They're wanting everybody to go online, register your portal for reporting and just kind of get that done, but nothing else can be done at this point. If you want to do that, again, Google HHS Provider Relief Fund and you'll find it. They did a really good job on that website. As a matter of fact, when we're done, I will share, actually, let me, well, here's a link, and then I actually downloaded this. Let me go back though. I've got some materials for you. That's what I'm trying to get out. It's the FAQs, and they're really good. They're many, many, many pages long. So reporting is still postponed indefinitely, but then the 2021 reporting is still scheduled for July of 2021. And so I think it's very possible for them just to roll 2020 into that same reporting period. There are a lot of FAQs out there that can be reviewed, and it addresses a lot of things. It addresses a lot of change of ownership questions. And then the other thing that has come out in the last couple of months, that's given me enough reason to pause and put it on my slide is they continue to stress that the allowable expenses cannot be reimbursed from any other source. So I think part of this comes from cost reimbursed providers. Now remember, CMS, they're talking to every kind of healthcare provider, dentists, chiropractors, health, medical doctors. And there are still some cost reimbursed programs. And so what they're saying is if you're cost reimbursed, then you're getting reimbursed through that program. And so therefore that cost doesn't qualify for your provider relief fund. None of us, home health, home care, hospice, nursing homes, none of us are cost reimbursed anymore. 14-year-old Chihuahua just got up. She'll have to wait. And so that I don't think is relevant, but I pointed out because they keep stressing this. Also, like I had a small provider out in West Texas, and she's like, we really didn't have to spend any money on additional PPE. I'm like, how is that possible? She said, well, we got it all from the state. So the state set up these drop sites where you could go pick up PPE for free. Again, you can't include that as an expense because you didn't pay for it. And so the fact that they're stressing that, coupled with the fact that they're stressing, which I think is on the next slide, you must report your expenses first. So a lot of people have asked, can we just report lost revenues? And they keep saying, no, you are expected to have additional expenses due to COVID. We want those reported first, then lost revenue. So my recommendation, if you have tremendous lost revenue and it easily accounts for all of your HHS provider relief fund, my recommendation is find a few expenses, some kind of PPE expenses, some kind of extra janitorial, anything that's COVID related, COVID bonuses, right? Find some expenses that are easy for you to find, document, and save, report those, and then just report the rest as lost revenue. And again, lost revenues has gone back to that very flexible rule where you can just compare budget to actual, you can compare prior periods we're scaling and then we tanked. You can use actual non-admits, not taken under care, refused services, loss of referrals, anything you can quantify and you can say this is because of COVID. Like if you can identify it, I used to not like it when people use the word quantify because this sounds dumb. I didn't really understand exactly what they meant by it. And now I use it all the time. And what I mean by that is, can you say, okay, we used to have Dr. Z gave us 10 referrals a week because he did a lot of hip and knee replacement and we did all his therapy. And he got shut down because elective surgeries got shut down. And so those 10 patients a week went away. Well, here's how you quantify that. You take 10 new admissions a week, and this is home health, but you can kind of extrapolate to whatever your service is. 10 referrals a week, and you know what? We usually paid about $2,600 an episode for that kind of patient. So 10 patients times $2,600 per week, bam, you just quantified it. That's how you quantify it. So think PAS. Well, Susie Q would not allow us into her home to see her daughter. And we usually provide 20 hours a week of services. We get paid $13 an hour. That's quantifying. You just add it all up. You got a name, but you start putting numbers with it. That's quantifying the impact of that. And that, do a spreadsheet. And it can be a combination. It can be a combination of lost referrals. Now you need to be careful that you don't double dip. You don't want to count lost referrals and reduced number of admissions because those are one and the same. You have less admissions because you lost referrals. So you got to pick one of those and not use both. But you can combine lost referrals. So those would be new patients combined with existing patients that drop services or wouldn't allow you in. Let's think you're a hospice. You've lost referrals and you've lost, so let's say your county lost admissions, like we normally would have admitted 10 patients this month, but we didn't. But also Susie Q denied entrance into the house, or Jane is in a nursing home and we couldn't go in at all. Those are not double dipping, right? Because you're looking at new patients versus existing patients you could put a name to. So that's not double dipping. Okay, that's all the slides I have. If HHS changes how PPP loans are treated after 4/30/2021, can we file a amended cost report later to remove loan amounts that were applied to wages that lowered our cost per visit for community care providers? I don't have an answer for that. So that's a stairs cost report. I don't have an answer for that. I will tell you, I'm waiting until the very last minute to file my stairs cost reports because of this ongoing debate. I know TAC got involved with it just yesterday, late yesterday. I don't know how much impact they're going to have. Dads, HHSC, as Sarah Mills put it, are being real asshats about this. It will effectively annihilate the entire rate enhancement program. Anybody got a PPP loan forgiven last year and reports their cost report as instructed by HHSC will lose all rate enhancement levels. We'll have recoupment for the entire year and will be dropped out of the rate enhancement program. I don't know how you can meet your rate enhancement requirements if you can't include wages that were included for PPP forgiveness. Take that for what it's worth. I know that you as a provider should be contacting anybody and everybody you can. We need a grassroots movement to get this rectified. But again, let me put that in perspective. HHSC is stating you cannot include wages paid that were used for forgiveness on your cost report. So you got an $800,000 loan, you just reduced your annual wages paid to attendants by $800,000. Do you still meet your spending requirements? I don't know anybody that will. New question. What about if you lost employees due to staff not wanting to go into patient homes due to COVID and you had to use contract staff? I don't know how that would impact anything. That doesn't really impact your provider relief funds, or, I mean, maybe you might could claim that as a provider relief fund expense because you had to pay $12 an hour versus maybe $10 an hour, or $25 an hour but versus $15 an hour, something like that. You might could include the difference for HHS provider relief fund spending. It wouldn't impact employee retention credits at all. So I'm not sure if that answers the question. Okay, that's all I've got, guys. I do have some resources to share with you real quick. So let me stop my screen share and I'm going to drop it in the chat box. And I'm sorry, I meant to do this. You can see I always have thousands of receipt bank is where it is. Things open. Oh, but I'm not sharing screen, so you can't see it. Bear with me. These are the provider relief fund. Oh, wait a minute. Oh, it won't let me attach it. The provider relief fund website is what I was going to, I actually downloaded those FAQs. So instead I'll just put the link in here. It's also in the slides, but if you want it, I'm dropping it into chat right now. So that's going to be your provider relief fund. Frequently asked questions. Again, they answer a lot of questions there, so check that out. I appreciate you guys hanging out. I don't see, oh, I got one more question. Can you use the HHS grant for payroll? No, not for regular straight payroll. You could use it for any additional pay due to COVID. If you did COVID bonuses, if you did, you know, an hazard pay, if you did an extra payment because somebody was, you know, going out and seeing patients. They don't have to be COVID, but like if you normally pay $25 an hour and you or visit and you tacked on $2 a visit extra, that extra could be counted, but regular straight payroll can't be included. I will include, so everybody that registered will get a follow-up email tomorrow afternoon. It will have a link to the recording, which always goes on my YouTube channel. I highly recommend just go to YouTube, search the Night CPA group, and subscribe. If you subscribe, you'll get notified anytime I put a video up. There are a lot of times that I will record a video just for my client base, and it might just be an update on Provider Relief Fund. It's the way I can get messaging out the quickest. And also I'm finding people watch the videos way more than reading a long email. So I'll record a video, put it on YouTube, and then put it in an email and send out an email. So if you subscribe, you'll get notified when I add content. But I always put my webinars on YouTube, so it'll be there. And then that follow-up email will also have the slides for whatever value they are worth to you. But again, I appreciate everybody. I really want to get onto some fun topics. I was thinking a fun topic for one of these webcasts would be my favorite tools, like my favorite technology tools and what might benefit you in your business. So just stay tuned, follow our emails. I try not to send out a bunch of junk, so just let us know what we can do to help you. Again, if you need our help with employee retention credit, even if you've got, we don't do payroll, so I can work with whatever payroll provider you have. Just email me and I can get you those engagement letters, okay? All right, thanks everybody. Have a good day. Oh, what about office items? Can it be used for HHS relief? HHS relief funds can be used for office items. There's no exclusion, but like if you put in like extra plexiglass, or I know some of my like CPA peers have cubicles and they put extenders up to further separate people, that could be included. If you had to expand office space so you could space people out, those expenses are legit. So all of that. I would recommend, if you want a lot of detail about the HHS spending and what could be allowed and not, go into YouTube and look way back in July. I did an HHS Provider Relief Fund webinar, and I think it's the one I did with Elia Care, and it was all about HHS Provider Relief Fund. It's still very relevant today. Nothing's really changed since then, so check that one out. If most of our stimulus, HHS stimulus, is applied to loss of referrals, what else can we spend it on besides regular wages? Anything extra, anything that's extra that you can stamp as COVID is what that HHS stimulus was intended for. So, computer. If you had to buy laptops so everybody could work remote, absolutely. If you had to increase your software so that everybody could work remote, absolutely. If you put in voice over IP services so everybody could work remotely, yes. Anything that you did because of COVID can be counted. You just really got to document it. And if it's something a little bit out there, if you will, to where you're like, okay, it's kind of hard to make the jump from this expense to that was done because of COVID, write a narrative, write a minute, like board minutes, board meeting minutes, or a note to file, write some kind of narrative about why that expense was incurred because of COVID. That's what you want to document. All right, guys, that's all I got for you guys. I'm gonna go eat some lunch because I'm hungry again. Everybody have a great day. Thank you.